basic framework that I'm looking at. And that changed after this $50 drop. I think at the low end, we should go to anywhere between 28.50 and 29. That would be a new all-time record high. At the high end, we could see gold go as high as 3,000, 3,100. I'm not one of those that call for gold to go to $5,000 or $10,000. Eventually, it probably will, but over time, it will have the relatively the same buying power. So I look at gold as the stability and the currencies as something that just continually are worth less and less. Again, in terms of buying power, not relative strength to other currencies.
Next year, gold prices could reach new highs, with a potential range between $2,850 and $3,100. While some predict gold might eventually hit $5,000 or even $10,000, that's likely decades away. The key driver for gold's value remains government overspending, which erodes currency purchasing power. Gold, by contrast, maintains its stability and buying power over time, making it a reliable store of value as currencies lose theirs. Gary Wagner, a seasoned market analyst and technical expert specializing in precious metals, particularly gold and silver, explains gold recently experienced a sharp $50 decline, breaking key support levels around $2,550. This drop followed the Federal Reserve's decision to cut interest rates by 25 basis points, which was widely expected. However, the market reacted strongly to Fed Chair Powell's cautious comments about the pace of future rate cuts. Despite earlier transparency from Powell and other Fed officials about a measured approach, many, including analysts, did not fully account for its impact, leading to a significant adjustment in gold prices. The Fed's dual mandate of stabilizing inflation and maintaining maximum employment has guided its recent actions. While inflation peaked at over 8.5% in 2022, the Fed's aggressive rate hikes brought it closer to its 2% target, albeit at the cost of some cooling in the labor market. Initially focused on curbing inflation, the Fed has emphasized balancing employment and economic stability. This pivot and slower rate cut expectations have added uncertainty to gold's trajectory, contributing to its recent volatility. Gary Wagner highlights that the U.S. dollar reached historic highs of 112 and 113 in March 2022, levels not seen in 6 to 8 years. Recent movements show strong support around 100, with key resistance at 106 and 107. Peaks like those in September 2022 are rare, and the dollar's trajectory will depend on factors such as GDP growth, fiscal policies, and the U.S. debt situation. Dollar strength is relative, often measured against currencies like the euro or yen. Its value is influenced by comparative policies, including how much each country debases its currency. Future movements will hinge on economic and policy decisions in the U.S. and abroad. Here are key insights from Gary Wagner's recent interview. Before diving in, don't forget to subscribe and hit the bell icon for timely updates.
I have major support at 25.50, and it's really based on these series of tops that come in, as well as it is just below the lows that came in recently. We broke through our former level of support, and you see this red line on top of it. It's simply referencing the lows that came in today, the opening of gold, and the low from yesterday, because yesterday, while everybody expected a 0.25%, a 25 basis point rate cut by the Federal Reserve, and more importantly, Powell's comments leading up to the FOMC meeting before what we call the blackout or quiet period, which is usually a 10-day period prior to a live FOMC meeting, he had been talking about the pace at which they would normalize interest rates. Because what's important to realize is when you go back to 2020, 2021, we had tremendous inflation come into the mix. I think it peaked at around March of 2022 at over 8.5%. The Fed was very slow to act. Many analysts, including myself, believe they really missed the boat. They could have handled it differently and started to work with interest rates by raising them to bring down inflation. Of course, that tends to contract the economy. They did not. So they had been playing catch up for most of the time. The trajectory that they want to see is a trajectory that leads them to a 2% target. But with the Federal Reserve, they have a dual mandate. One is to keep prices stable. And so to them, that's a 2% level of inflation on an annual basis. And the second and critical component of their dual mandate is maximum employment. And so once they raised rates, they effectively took the level of inflation down substantially, never quite to that 2%. However, they did take it down, but by doing that, they had some cooling of the labor market. And so at first, as they raised rates, the Fed focused on getting inflation in check. That was the number one objective of the Federal Reserve. And most importantly, it was what they looked at over full employment or maximum labor. But by doing that, the economy should contract. That's the whole idea behind raising rates. It slows everything down, economically speaking, and therefore the labor market will cool. They recognized that the labor market was headed to a place they didn't want to see, and were content with the fact that although inflation wasn't at 2%, it was a couple of points away. So they shifted their focus. And what I found interesting about the last FOMC meeting of the year was the fact, while everybody expected a rate cut of 0.25%, 25 basis points, and Powell had been really transparent, talking about how they don't want to hurry in terms of rate cuts, they want to slow the pace down, I don't think people took it literally, including myself. And for the most part, we thought that doctrine or rhetoric by Powell and other Fed members was fairly baked into current pricing of gold, as well as a 0.25% rate cut. And boy, we were wrong, because we saw a $50 plus decline in gold. And we've seen the dollar recently, what was this, back in March of 2022, peak above 112, 112, 113. Historically speaking, these are the highest levels we've seen in the last 6 to 8 years. So the numbers that the one analyst is calling for, I don't know where he is ascertaining or deriving that conclusion. I, as a market technician, have to look at the data, look at where a particular stock or commodity or currency has been, and ascertain how likely it is that it will achieve that level again. The same with the lows. If, as you can see, once the dollar came down, it bottomed here right at around 100. Here's another bottom right above 100, and the most recent bottom is 100. And if we draw this line across, we can see where it's solidly, this is again a weekly chart, solidly above it to about 103, and then kind of meandered back down over a 2-week period to where it went back to right around 100. So we know that 100 is a critical point in the dollar. We know that these series of tops at 106, 107, technically speaking, we've got good historical data. But these tops up here that came in September of 22 is a very rare occurrence. So where do I think the dollar will go? That's going to have to do a lot with GDP, of course. It's going to have to do with policies of the next administration. And most importantly, I believe it will have to do with the fiscal debt of the United States, whether it's growing again and to what degree, and what the other countries that the currencies it's kind of based against are doing also. In other words, when we say there's dollar strength, we're saying the dollar might be stronger than the euro or the Japanese yen. And a lot of that has to do with their policies versus our policies. How much are we debasing our currency relative to what other countries are doing to debase theirs?
In a recent interview at SOA, GaryWagner financially exposed gold's recent rise alongside the dollar's strength and highlighted its ability to overcome the headwinds of a stronger dollar. Since September, the dollar has gained 8%, yet gold surged to an all-time high of $2,825 on February futures by mid-October. This reflects significant resilience in the gold market. Following a sharp sell-off from $2,700 to $2,600 in December, a move of over $100, the key question is whether gold can find support at current levels. Its future trajectory will depend on how well it stabilizes after this correction. Moreover, Gary points out that economic factors like U.S. dollar debasement and geopolitical uncertainties influence gold's value. Rising global conflicts tend to strengthen gold, while peace and fiscal discipline by major governments could push prices lower, though such scenarios are unlikely. Current support for gold futures at $2,600 is critical, with resistance levels at $2,725, $2,760, and $2,800 before potentially reaching $3,100 depending on market conditions. GaryWagner is concerned that the Fed's revised economic projections, including a higher normalized interest rate target of 3.9% for 2024, have already lowered the dollar and gold. Future policy shifts, particularly if inflation rises due to tariffs or other factors, could lead to a more hawkish Fed stance, significantly impacting gold prices. Now, let's get back into the interview.
In other words, when you see gold and the dollar moving higher in tandem, realize that for gold to move higher with dollar strength tells you that it first overcame that dollar strength. So when we consider that the dollar has gained 8% since September, and then we look at this chart at the, let's say the second week of October was the final blast from about 2646 up to the all-time record high just above 2800. I am looking at February futures, the continuous contract, for those that are wondering why it's showing the high at 2825 when spot was just about 2802 or a little bit below, and most active futures when it was December was right around 28. So they don't get confused. This is a continuous contract of February gold futures. In terms of what I think, the first question we have to answer is, will gold find support after this sell-off from 2750 down to 2600? It's over $100 move, and that move occurred between the 12th of December and the current date. So we have been focusing on the economy and the debasement of the US dollar. The other component is geopolitical uncertainty and the amount of conflicts in the world, because that's another thing that gold tends to hold value against. Is the crazier stuff gets, the stronger gold prices get. And so if we, by some slim chance, figure out how not to wage war against each other, that would take gold down tremendously. Do I think that probability is high? I think it's nil.
Gold's trajectory next year will hinge on its ability to stabilize after recent corrections and broader economic and geopolitical factors. While the dollar's strength and the Fed's policies create headwinds, gold's role as a hedge against uncertainty and currency debasement remains intact. Key resistance levels and potential geopolitical shifts will be crucial to watch as the year unfolds. How might geopolitical tensions or resolutions impact gold prices in the coming year? What indicators should investors monitor to effectively gauge gold's support and resistance levels? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.